How's it going today, guys? Welcome back to my series here on the stock market for beginners. And in this video, we're going to be talking about whether or not you should open a cash account or a margin account. So when you're opening up a brokerage account for the first time, typically you have two options. Do you want to open a cash account or a margin account? And if you don't know what you're doing, you could make a mistake at this point in time. So I want to tell you more about this and whether or not you should be opening a cash account or a margin account. Now, before I get into this video, I just want to remind you guys that if you're looking to learn more about investing in the stock market, I do have a completely free course called How to Find a Great Investment. The link for that is in the description below, and you guys can take that right after you watch this video if you want. It's under 1 hour, and it will teach you a lot about the basics of investing and finding a good investment opportunity out there. But let's go ahead and cover the difference now between a cash account and a margin account. And we're going to start off with the cash account because this is what 99% of people out there are looking to open. So if you already opened a cash account, good news, you did the right thing. And if you opened a margin account, well, you might be able to switch back or just understand there are features available in that account that you probably will never want to use. But first of all, with a cash account, there is no borrowing of money. So your deposit in that account is equal to what amount of cash you put in. So if you put $2,000 into that account, your balance in that account is $2,000. You can't borrow money or get a loan through a cash account. Now, with a cash account, your trades are paid in full in cash by the fund settlement date. So you have to pay for your shares in full at the time of the settlement date. There's no short selling with a cash account, so you can't bet against stocks and borrow shares and pay interest to your broker. So if you're interested in short selling, you have to do that in a margin account. Now, the other thing is you have to follow the pattern day trader rules if you are using a cash account. If you're doing too many day trades in a cash account, you can actually get your account frozen for 90 days or so if you're actually doing day trades or too many day trades in a cash account in a trading week. You have to look up those rules, the pattern day trader rules. And you also have to follow the fund settlement rules because what's going to happen is when you actually go about selling a stock, they're going to deposit the money into your account, but it's not available until the fund settlement date to be reinvested or cashed out. But what they allow you to do, they allow you to invest that borrowed money on a good faith agreement that you're not going to be selling that stock that you purchased with borrowed money. So if you buy a new stock with the proceeds of a stock that you sold, and then you sell that stock the next day, you have now bought and sold the stock with borrowed money from your brokerage, and you're going to get your hand slapped. You're either going to get a letter or an email from your broker or a phone call, or they may just freeze your account for a set number of months or something like that. That's what's called a free ride, and the SEC does not allow you to do that. So you want to keep that in mind as well. But as long as you're not actively trading in and out of stocks, you don't have to worry about day trading rules or the free rides or fund settlement rules like that. But moving on, like we said, your account balance is equal to the amount that you have deposited, and there is typically not a credit check with a cash account because all they are doing is verifying your identity. They're not loaning you any money, so you really don't have to worry about a credit check or that affecting your credit score. And shares are not being lent out to short sellers with a cash account. We'll talk about that more when we go into the margin account. So now let's talk about that margin account. So first of all, with a margin account, you're allowed to borrow money from your broker and you pay interest on that loan. Now the typical margin rate is as high as 50%, or it's usually 50%, but not usually higher. So if you put $2,000 into your margin account, your broker would likely loan you $1,000. So your total buying power is $3,000, but only $2,000 is cash and $1,000 is your actual loan from the broker. But the thing is, if you invest that $2,000 into stocks, you can still invest with that margin and use your stocks as a collateral for that debt. So this is a very fishy territory for a beginner. You don't want to be buying on margin, but people who know what they're doing like to get that leverage. They like to employ leverage in the stock market and buy more shares and use their cash or stocks as collateral. But there's a lot of things that you need to know about this. So first of all, you're going to pay interest on that loan if you're using that money. If you use the money loaned to you by your broker, you're going to pay interest. There's probably going to be a credit check. I can almost guarantee they're going to be running your credit because they are loaning you money at that point in time. This is what you're going to be doing if you're trying to be short selling. That has to be done in a margin account. And if you're doing day trading, this also has to take place in a margin account. And the other thing is, when you have a margin account, your shares that you're holding might be lent out to other short sellers. So we're going to talk about short selling down the road, but just understand your shares that you have purchased might actually be lent out to other investors. And there's something called a margin call where let's say you're buying on margin and now all of a sudden you made a very bad investment. Well, they can basically call you up or send you an email and say you need to deposit more money by this date, otherwise we are going to automatically sell your stocks to cover the loan that we've given you that you haven't paid us. So there's such thing as a margin call. It's kind of like having your car repossessed. They're going to repossess your stocks and take the money. So that's something else you run into with a margin account. But anyways, guys, as you can imagine, most people want to just have a cash account. I don't mess around with margin. I don't really know anyone who does, but I just wanted to explain the difference in this video. But thank you guys for watching this. I hope you enjoyed this video, and I will see you in the next one. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.